The smarter you are, the worse your financial decisions can become, and most people don't realize it's happening. Meet Daniel. Daniel is exactly the kind of person you'd expect to be good with money. He has a graduate degree, a senior role at a tech firm, a salary that places him comfortably in the top tier of earners in his country. On paper, Daniel should be very good with money. He reads financial news before work, listens to market podcasts on his commute, understands, at least in broad terms, how investing is supposed to work. Daniel also has $340,000 sitting in a single stock, his employer's stock. He's been watching it for 3 years. He knows concentration risk is real. He knows diversification exists for a reason. He knows, in a purely intellectual sense, that tying most of your net worth to the same company that pays your salary isn't exactly sophisticated portfolio construction. He explains this concept very clearly, sometimes to other people. He just hasn't acted on it himself. He hasn't moved the money. Not because he doesn't know what to do, but because knowing isn't the problem. Every few months he tells himself he'll rebalance, and every time the moment comes, something interferes. When the stock rises, selling feels premature, like walking away from momentum. When it falls, selling feels even worse, like accepting a loss that might still reverse if he's patient enough. There's always a reason to wait, always a logical sounding explanation for why now isn't quite the right time. Meanwhile, a colleague with far less financial knowledge and significantly less income has been quietly contributing to a diversified index fund for years. No forecasts, no tactical shifts, no elaborate strategy, just consistency. Her net worth is growing faster than Daniel's, and Daniel can't quite understand why his intelligence isn't translating into better outcomes. Here's what's actually happening. It has very little to do with how smart Daniel is. In fact, his intelligence might be making the situation worse. Daniel isn't unusual. In fact, he represents one of the most consistent paradoxes in behavioral finance. The investors who feel most confident in their ability to outthink the market are often the ones who underperform it. The people with the most sophisticated analytical frameworks don't necessarily avoid mistakes. They often make more elaborate versions of the same basic ones. And individuals with the highest levels of financial literacy are frequently the most vulnerable to a specific set of cognitive traps, not despite their intelligence, but partly because of it. And this is where it gets uncomfortable. This isn't speculation. It's a well-documented empirical pattern. Research found that investors who see themselves as knowledgeable tend to trade more frequently. And over time, higher trading frequency is strongly associated with lower returns relative to simple passive strategies. Because financial knowledge doesn't just influence the quality of decisions, it increases the number of decisions people feel compelled to make. And in investing, more decisions often means more opportunities for error. So what's really happening here? This isn't a lack of intelligence. It isn't a lack of information. It's about a set of cognitive patterns that intelligence doesn't fully protect against, and sometimes quietly amplifies. Once you understand them, you begin to notice them everywhere. In market commentary, in investment debates, in your own reasoning, especially when the stakes start to feel personal. And this is where intelligence quietly turns into a liability. The first pattern is overconfidence. As people develop deeper knowledge in a domain, confidence in their judgments usually increases. In many fields, that relationship makes sense. Expertise often does lead to better outcomes. Financial markets are different. They are complex, adaptive systems with uncertain feedback loops. Environments where analytical skill and predictive accuracy don't always move together in the way we intuitively expect. Research in behavioral finance found something consistently striking. Professional fund managers, individuals whose careers are built on market analysis, supported by research teams, years of experience, fail to outperform simple passive index strategies in the majority of long-term comparisons. Not some of them, most of them. Retail investors, people managing their own portfolios, tend to perform even worse on average. Not primarily because they lack intelligence, but because they operate with the same overconfidence bias without the institutional structures that sometimes help constrain it. Overconfidence in investing shows up in recognizable ways. It shows up in the belief that market entry and exit points can be identified with reliable precision. Yet studies on market timing repeatedly show that even sophisticated professionals achieve results barely distinguishable from chance over extended periods. It shows up as the belief that you've identified something the market hasn't priced in yet, that your personal interpretation of a company, a sector, a macroeconomic trend is more accurate than the collective judgment of millions of other participants, many operating with significant informational and analytical advantages. And it shows up, most expensively, as the tendency to interpret gains during favorable market conditions as evidence of skill. Wealth accumulated during prolonged bull markets often feels like validation of analytical ability, until the environment changes, and decisions that once seemed intelligent begin to produce very different outcomes. This is where Daniel's situation becomes more understandable. 3 years of observing a concentrated position. 3 years of carefully reasoned arguments for delaying diversification. The issue isn't a lack of intelligence. It's that intelligence can construct explanations that feel entirely rational from the inside, even while quietly reinforcing risk. The second pattern is confirmation bias. In today's financial information environment, it has become significantly more powerful than it used to be. The mechanism is simple. Once we form a belief about a stock, a sector, or the direction of the economy, we begin to interpret new information through the lens of that belief. Supporting evidence feels persuasive. Contradictory evidence feels questionable, incomplete, or easy to dismiss. This tendency is universal. No investor is entirely immune to it. Here's what makes it particularly consequential for financially sophisticated individuals. The more analysis you consume, the more opportunities confirmation bias has to operate. In a high-information environment, there's almost always a credible-sounding argument available for any position you've already taken. As a result, the ability to locate supporting evidence can start to resemble and feel like objective evaluation. In investing, this pattern often becomes visible after a position is established. An investor buys into a thesis, then spends the following weeks consuming information that reinforces it, while gradually discounting signals that challenge it. The outcome of the investment may still be favorable, but the decision-making process sustaining it is no longer neutral analysis. It has shifted into a more refined form of rationalization. And refined rationalization is particularly difficult to detect, because the reasoning supporting it can sound entirely convincing. The third pattern is more subtle, and in some ways, the most psychologically compelling. Psychologists refer to it as the illusion of control, the tendency to overestimate our influence over uncertain outcomes. In investing, this often takes a very specific form. It appears as activity. When investors feel uncertain or anxious about their finances, the instinctive response is to do something. Check portfolios more frequently, adjust allocations, seek new analysis, refine strategy. The activity feels constructive. It feels disciplined. It creates the impression of responsible engagement with an uncertain environment. But in long-term investing, activity and outcome have a complicated relationship. More adjustments don't reliably produce better returns. More frequent checking doesn't improve performance. More complex strategies do not, on average, outperform simpler ones. What activity primarily does is create the feeling of control over a system that remains largely unpredictable. Financially sophisticated individuals can be particularly exposed to this dynamic. Greater analytical ability provides more tools for intervention and more ways to generate decisions that feel purposeful. The intelligent investor can almost always find something productive feeling to do with their portfolio, which means the illusion of control is always available to them. Think about it this way. 2 investors hold identical index fund portfolios. One checks and adjusts quarterly. The other checks and adjusts weekly, running analysis, reading research, making small tactical shifts based on new information. The second investor feels more engaged, more informed, more in control of their financial future. But over an extended period, the first investor has almost certainly outperformed them. Not because passivity is inherently superior, but because the activity was generating the feeling of control rather than actual returns. And the cost of that activity, in transaction fees, tax implications, and the statistical risk of mistiming, accumulates quietly over time into a significant performance gap. What connects all 3 of these patterns, overconfidence, confirmation bias, and the illusion of control, is not a lack of intelligence. It's intelligence being directed toward the wrong kind of problem. Overconfidence occurs when analytical skill is applied to environments that are inherently unstable. Confirmation bias reflects research capability being used to reinforce existing conclusions, rather than rigorously test them. And the illusion of control is the problem-solving orientation, the instinct toward action, engagement, finding the lever to pull, being applied to a system that rewards patience and non-intervention more than it rewards sophisticated management. These aren't failures of intelligence. In fact, it's the opposite. It's highly capable reasoning, operating in an environment it was never designed for. In most careers, being proactive, analytical, strategically engaged drives success. But in the markets, those same traits can quietly sabotage long-term performance. Research in this area found something that is genuinely worth sitting with. The investment strategy most likely to outperform over a long horizon, consistent contributions to a diversified, low-cost index fund with minimal interference, requires almost no analytical skill to implement, and it requires a great deal of psychological skill to maintain. Specifically, the skill of not doing things, of not reacting, of not optimizing, of sitting with uncertainty without converting it into activity. That is genuinely difficult for people who have built successful careers on being analytically engaged, strategically active, intellectually confident, which is most of the people reading their third financial article of the morning before the market even opens. You may begin to notice these patterns in very specific moments. Overconfidence often becomes most visible after periods of strong performance. When returns have been favorable, the instinctive attribution to personal skill can feel entirely justified, and the decisions that follow, increased concentration, more active positioning, heightened conviction, often reflect that attribution. Confirmation bias tends to surface in how contradictory information is processed. Notice the next time you encounter analysis that challenges a position you hold. Is it evaluated with the same openness as material that supports your view? Or does the scrutiny intensify, a quick search for weaknesses in the argument, rather than a reassessment of the underlying assumption? The illusion of control usually shows up most strongly during periods of market volatility. The urge to do something, anything, when the portfolio is moving in the wrong direction. The feeling that inaction is irresponsible, that a sophisticated investor should be responding to changing conditions, rather than sitting patiently with a long-term strategy. All three of these feelings are completely normal. They're the predictable output of an intelligent mind encountering an environment that doesn't reward intelligence in the ways it usually does. Recognizing them in real time is often the first step toward managing their influence, rather than being guided by them. And this is where analytical perfectionism becomes a trap, waiting for the perfect moment to fix an imperfect position. Daniel doesn't need a dramatic, all-or-nothing decision. He needs structure. One approach is to define a hard ceiling, a simple rule that no single holding will ever exceed a fixed share of total net worth. Anything above that threshold becomes a routine rebalance, not a high-stakes act of judgment. If reducing the position all at once feels psychologically costly, he can do it in tranches, gradually transferring portions of the holding into a diversified core over time, not as a market timing strategy, but as a way of removing the burden of perfect timing altogether. Because the real objective isn't predicting the next price movement, it's ensuring he is no longer the primary obstacle to his own long-term compounding. Here's what this ultimately implies. For highly analytical, high-achieving individuals, the most important financial skill is not finding better information or constructing more sophisticated investment frameworks. It is recognizing when intelligence itself begins to distort judgment, when confidence quietly shifts into overconfidence, when detailed analysis gradually becomes rationalization, when sustained activity reflects the illusion of control rather than genuine strategic necessity. This is not an argument for disengagement. Some investors introduce deliberate friction into major decisions. A simple rule: any significant portfolio change requires a 48-hour delay, not to prevent action, but to ensure the decision survives the cooling of emotion. Others automate contributions and rebalancing processes, not because they lack confidence in their judgment, but because they understand how judgment behaves under pressure. Structure, in this context, is not a workaround for weakness. It is a recognition that even well-calibrated intelligence benefits from a buffer between impulse and execution. Long-term performance research has repeatedly highlighted what is often called the behavior gap, the difference between what markets deliver and what investors actually capture. This gap is rarely driven by information or strategy alone. It emerges from intelligent, well-intentioned intervention, compounding quietly over time. Across multiple studies, estimates of this difference frequently fall within a range of 1 to 3 percentage points annually. Compounded across decades on a substantial portfolio, the financial implications become significant. That's not a rounding error. On a $1 million portfolio, that can be the price of a house, lost simply by trying to be smarter than the system. And in many cases, it is intelligence applied to the wrong problem. So the next time you feel the pull toward a more sophisticated strategy, a more active approach, a more confident interpretation of where markets are heading, pause. Not to abandon analytical thinking, not to disengage entirely, but to ask one question: is this intelligence working for my long-term financial independence or quietly working against it? Because from the inside, they feel identical. Overconfidence feels like clarity. Confirmation bias feels like careful analysis. The illusion of control feels like disciplined engagement. The difference is rarely visible in the moment. It tends to appear later, in the returns, in the compounding that didn't happen, in the gap between what the strategy would have produced and what the interference produced instead. Intelligence did not create that gap, but in a measurable and remarkably consistent way, it can quietly help sustain it. If this shifted how you think about money, you're exactly who this channel is for. Hit that subscribe button. I'll see you in the next one.